Listen up, because this is the kind of thing nobody's telling you in plain words, and it's killing your results. You're grinding every day, building businesses, managing assets, chasing opportunities everyone says are safe or balanced. But deep down, you feel it. There's always this gnawing risk, this volatility that drags you down when markets wobble. You try diversification, spreading bets, hoping it cuts the downside, but it never does the job the way it should. You're tired of the same old formulas that sound good but fall apart the second things get rough. The frustration is real, right? Having your capital swing wildly, missing steady growth, or worse. Watching your portfolio bleed while everyone else quietly pulls ahead. That's the hell of investing without the right approach. Now here's where risk parity shakes the table. It's not just a buzzword, it's the physics of portfolio building turned inside out. Forget loading up on stocks just because they're growth or dumping bonds because they're safe. The smart investors, those who actually build resilient, predictable structures, don't chase returns, they chase risk. Want to tame uncertainty? You spread risk evenly across asset classes. That means bond volatility, stock drops, commodity swings, all balanced, so no single shock can cripple you. This isn't lip service, it's math, it's discipline, and it's brutal honesty about what markets do. Here's what nobody warns you about. Risk parity demands more than just reweighting your portfolio by volatility. You've got to sweat the details. Correlations that shift when panic hits, hidden risk factors in alternative assets, capital efficiency that doesn't swallow your gains in trading costs. Most people stop at naive diversification and call it a day. Don't be most people. Exploit leverage smartly, so your bonds can carry more weight without dragging returns down. Use futures and derivatives to amplify control, but don't let fancy instruments make you reckless. Calibrate your portfolio with constant stress testing, because risk is alive. It moves, it morphs, it attacks where you least expect. And to the founders, investors, leaders watching this now, don't settle for complacency. Your edge comes not just from picking winners, but designing the container that holds them. It's the architecture of how you allocate capital daily that defines if you survive and dominate or fold under pressure. Risk parity is the framework that stops your portfolio from riding on a single wave or storming ahead blindly. It's the shield when markets break, the engine when they rally steadily. Start now. Strip your portfolio of old biases. Stop overweighting trends without proof. Stop burying yourself in outdated benchmarks. Measure volatility like a hawk. Don't just rebalance on arbitrary dates. Rebalance dynamically, respecting when risk patterns shift. Add assets that don't scream returns but scream low correlation. Hedge the tail risk aggressively. Push leverage cautiously but decisively to stabilize returns without gambling your base. This is how the best hedge funds navigate chaos. This is how the smart money not only survives crashes, but comes out with growth others dream about. You want to be a player, not a victim. Risk parity isn't some theoretical model. It's the modern portfolio's wake-up call. It's brutal, it's precise, it forces you to face the ugly facts, and then use them to craft order from chaos. Get obsessed with risk over return. Harness risk parity and watch your portfolio stop swinging wildly and start moving forward, with power, stability, and clarity. This isn't a trick or a fad. It's the tool built by the pros, for the pros. If you're serious about owning the future and not just surviving the next crisis, adopt risk parity like your life depends on it. Because frankly, it does. Subscribe to our YouTube channel and open the featured link to discover more.